Welcome everyone today to our session on tax considerations for structuring investments into the United States. We are delighted to have with us Mr. Raj Tanden, partner at Foley in Lardner. Raj, thank you so much for joining us today. Questions regarding US-India investment structuring come up very often in cross-border structuring questions, especially in the context of flips where Indian holding structures are often sought to be flipped to the US holding structures. Rajesh, just to set the tone for this discussion going forth, could you tell us some of the key reasons why such US-focused structures or flips are considered by investors in India?
Thanks, Varsha. I think historically, when you start looking at it, and going back to the days when sort of outsourcing started, you had two sort of different trends that were there. You had some outsourcing companies which were incorporated in US and then had their captives in India. Uh, and you have multiple different examples of that. And at the same time, you've had Indian headquartered companies also, where they do open up branch offices or incorporated companies in the US, but most of the work is actually done from India. But as we have sort of evolved over a period of time, especially depending on the nature of the business, outsourcing is one part of it. But as we start getting into something like products business or certain businesses where the key market is actually in the US, we do see a lot of entrepreneurs wanting to see whether should we just start in US or should we flip over to the US. Multiple different reasons which are there, starting from the pool of capital or the access to the pool of capital, because yes, you do have a lot of funds which are India focused and which also look at India as a market, but you get access to a larger pool of capital, so to say. People who essentially look at US as the US companies for investments. So that's one key reason. Second is possibly in terms of saying that yes, we are actually a US company. We have global operations, but we are primarily a US company. I always think back to the example of Cognizant, which even though most of the workforce is actually in India, it's still regarded as effectively a US company. So, and especially when you're looking at certain kinds of, let's say, niche products that you're looking at, sometimes being projected as a US company actually works better. There may be sometimes access to contracts where for certain types of contract or government contracts, you may need to have US incorporated entities. So those are some of the different sort of reasons which are there. I would sort of tend to put in tax right at the bottom of the chain, because people generally shouldn't or don't really look at flipping or externalizing or incorporating purely for tax driven reasons. It's usually a lot of business reasons which go into as to why a company wants to be incorporated, whether it's talent pool, whether it's contracts, whether it's the fact that how they want to be perceived in the market. These are some of what I would call the different sets of reasons why whether companies or entrepreneurs do want to sort of look at being seen as a US company, or actually trying to see whether they can incorporate a US headquartered company. But as I said, tax is always, I would sort of put it to the side. It's a consequence, but not really the reason for changing your structure around.
Thanks for that, Rajesh. So diving right in, Raj, going to throw this question to you. Could you enlighten us on some of the typical structures that are seen in context of non-US investors that want to invest into the US?
Yeah, so Varsha, do you want to pull up the slide? This is sort of I guess historically at least, the structure we see very often used for US operations for a new operation in the United States, if you're starting from scratch. And we'll talk about how we would incorporate an Indian company into the structure through a flip transaction. And it's commonly referred to as an Up-C structure. The reason why it's referred to as an Up-C structure is that if you look up, you will see C corporation. And what is a C corporation? A C corporation is basically your general US corporation that pays corporate tax in the US like any other corporation, any corporation you see that's essentially publicly traded in the United States, public or private, it pays tax like every other kind of company. You'll also see what we call S corporations. S corporations don't pay tax like regular corporations, but among other things, they can't have non-US investors, so you don't see that in the structure. Below the structure or the C corporation, you'll see an LLC. And the LLC is essentially the operating company. So we would call the LLC an operating company or an OpCo, and that will actually operate the business or hold the Indian subsidiary, as you'll see later on. And you'll see the C corporation as essentially a holding company, a mere investor in that LLC. And we'll also see that these entities are organized in Delaware. Delaware is a state in the United States, and it's most typically used for incorporating companies in the US because of its very highly developed corporate laws and very well established court system to resolve corporate disputes. So if we were setting up entities from scratch, like I said, we would use this structure or a similar structure we'll talk about, and we would organize them in Delaware. And what are the benefits of the structure? Well, the benefits are that for tax-exempt investors, and I guess you should turn to the next slide, Varsha, because we get into what the benefits are there. Yeah, so why do we see the structure? Well, we see the structure because what we call tax-sensitive investors, they come in and they invest through the C corporation. For example, if an Indian investor invested directly into that LLC, they would have what we call effectively connected income. They would have to file US tax returns like every other investor. When they sell their interest in the LLC, they'd have to pay full US corp, or I should say individual taxes. They'd have to pay taxes just like every other individual. They would have to, any other US individual, they would have to file US tax returns. They would be subject to US tax audits. It's very messy, and most non-US investors want to avoid that. Also, a very large group of investors in the United States are tax-exempt investors, and they also need to be protected from adverse US tax consequences. Those consequences fall into the basket of unrated business taxable income. So you may often hear these terms, UBTI and ECI. These are the adverse consequences that arise for these tax-sensitive investors, and they avoid those consequences by investing into that C corporation holding company. Yet the structure also provides a benefit to taxable investors. If you're a regular taxable investor like myself, you want to invest in a pass-through for US purposes because you get a single level of taxation. And also, when I sell my interest to a buyer, that buyer can also get certain tax benefits. There are other benefits too, but in a nutshell, investing in a pass-through for a regular taxable investor is pretty advantageous. I avoid two levels of tax. A corporation for an individual has to pay essentially corporate tax on its earnings, and then when it pays dividends of that income out, there's taxation again or capital gains on an exit. By contrast, with an LLC or partnership that's set up as an LLC, there's a single level of tax, so I avoid that double tax. There's a benefit and an exit to a buyer. And like I said, there are other benefits too. So it's very tax efficient for taxable US investors. In addition, obviously startups are looking at compensating employees with equity. And the best kind of equity compensation you can give to an employee is a profits interest in the LLC. And why is that advantageous? It's because by and large, I can give that LLC interest to the employee completely tax-free. And when they sell the interest, whether back to the company or in an IPO or other exit, they get full US capital gains treatment. And capital gains treatment very generally qualifies for almost a 50% reduction in tax. You'll pay 37% in federal income tax for a for ordinary income, income passing through the LLC. By contrast, capital gains qualifies for a tax of 20% or sometimes 24%. So it's a huge reduction in tax, maybe about half. Other alternatives are you give an employee stock options. You can give an employee a stock option completely tax-free, but when they sell the options, it's all ordinary income, so they pay more in taxation. Alternatively, you can give them stock. you can give them stock in that C corporation by way of example, or just stock in a corporation without this dual tier structure. And they have to pay essentially tax on the full value of that stock on day one, or as that stock vests, depending on what elections they make. Well, of course, this is what we call phantom taxable income, because they've received no cash, they've just received this property stock, and yet they have to pay tax on it. So not very efficient. By contrast, LLC profits interest, very efficient. Lastly, we have sort of a great ease of exit, right? The blocker investors can sell their C corporation stock. And by the way, for the Indian investors, that's completely tax-free for US tax purposes. There's no US tax to be paid. And the LLC investors, they sell their LLC interest, and everyone receives the same value. Doesn't matter if you sell your C corporation stock or your LLC interest. If they're worth basically $100 a share, you get $100. No one receives anything different. So it's become a very, very common structure. And like I said, we'll show how we would flip an Indian company into the structure as well. And we're actually helping a client right now do this exact same thing.
Thanks, Raj, for laying that out. We see these kind of structures. Obviously, we just heard about it from the US perspective from you. There are a lot of Indian legal and tax issues that come aligned with such structures when there's an Indian tax resident that's trying to invest into the US. Harshita, could I now throw it to you to shed light on some of the most common legal issues and exchange control issues that come up and need to be kept in mind when investing into the US?
Sure. So I think if you look at it from an Indian legal and regulatory perspective, the first thing that really strikes our mind is can the resident Indian individuals remit money out of India to subscribe to the shares of the US entity that they've set up as a holdco? And the answer is under the liberalized remittance scheme of the Reserve Bank of India. The resident individuals are allowed to freely remit up to USD 250,000, per financial year, which is April to March, for all permissible current and capital account transactions. And this becomes a popular route adopted by a lot of Indian promoters for the purposes of making investment abroad. In these holdco structures, whether it is for acquisition, or holding of shares of both listed and unlisted, overseas company. Now, another, big challenge that we see when we are flipping these entities from an Indian regulatory perspective off to the US or any other jurisdiction is round tripping. So, what is round tripping? And we've heard this word a couple of times, and a lot of you may have also, be aware of this term, or may have heard it from your advisors. So, round tripping is essentially the practice of investing back into India through a foreign holding company. Which is, to put it, to break it further, the money which is originating from India goes to the US and comes back into India. So if Indian shareholders are setting up a company in the US that essentially sets up another subsidiary in India, RBI, the Reserve Bank of India views it as a round tripping concern here. Now, why does it become a concern? Because historically we've seen Indian parties who have taken advantage of, friendly tax treaties with the countries where such holding companies are set up to invest monies back into India. So the RBI has traditionally frowned upon such practices for two reasons, because not only does it encourage tax avoidance, but it also becomes a route to launder back, black money into the country. In May after having seen these kind of practices creeping in May 2009, the Reserve Bank of India, came up with an FAQ, the ODI regulations, where it expressly clarified that Indian parties are not permitted to set up an Indian subsidiaries through their foreign WOS or JVs, which is through their foreign entities. The provisions also go ahead to prohibit Indian parties to acquire a subsidiary as a direct or an indirect investment in India. In such, though it's, that is the general rule or general clarification that RBI issued, there are exceptions in which the RBI entertains applications for getting money back into the country. And in those cases, the Indian parties need to approach the Reserve Bank of India through their authorized dealer banks. And depending on the merits of the case, the Reserve Bank of India may consider their applications. So although the RBI implies that a restriction against round tripping practice has always been inherent, in the regulations, what is interesting to note here is that there is no express language in Indian law which really prohibits round tripping or explains what round tripping is. So that becomes a very important consideration, when you're formulating and devising a structure, and deciding to flip. Bear in mind that you do not fall into into the issue of round tripping, and the monies that you're using is not coming back into India for setting up a subsidiary, or they're not coming back into India for to be used here. So that's another big concern apart from the tax considerations, which we'll be discussing later by the panelists.
Thanks, Harshita. Just touching on the Indian tax issues that need to be kept in mind, while investing into the US, or while any Indian resident is investing abroad. And these are some, one can call them atypical issues, in the sense that we don't have similar provisions in domestic laws of all countries. The first is what we call the Section 56 or the gift tax issue. Section 56 under India's domestic law is essentially a provision which is a residual head of income. And amongst the other types of income, there are certain provisions which are otherwise called gift tax provisions under Section 56. And what the relevant provisions of Section 56 say is that when a person is receiving property of some kind, having paid less than the fair value of the property to have received it, that person is going to be taxed on the fair value of the property, or whatever is the difference between what they paid and the value of the property they received. Now, when we say property, this includes immovable property and certain types of movable properties as well. And it specifically includes shares and securities of companies. So it needs to be borne in mind that when a person is investing into the US, whether it's an individual or a company from India that's investing into the US, Section 56 can come into play. There are certain exemptions under the law from Section 56. So if you're receiving these kind of properties which are gifted from certain linear ascendants or descendants, or certain specified relatives, then you don't fall foul of the provision. Similarly, if you're receiving those shares or securities under a will or by way of inheritance, you don't fall foul of the provision. However, this again, these provisions can be really draconian and need to be kept in mind. The question then arises: what is the fair value of the property that needs to be considered? And fair value has been defined very specifically under a particular set of prescribed rules under the income tax rules, which very broadly speaking, for equity shares prescribes a book value based computation, whereas for preference shares, it says whatever is the price that the shares would fetch in the open market, as certified by a report of an accountant or a merchant banker. So these aspects need to be kept in mind from a Section 56 and an investment perspective. The other tax aspect that needs to be kept in mind is what we call the POEM risk, or the place of effective management risk. What is the POEM, or the place of effective management risk? It's basically a residence criterion that's prescribed under Indian domestic law for companies. Why is it relevant? Well, under Indian laws, if you are a tax resident of India, you're taxable on your worldwide income. But if you're a non-resident under Indian laws, you're taxable to the extent of your Indian sourced income. That can mean a world of difference for companies situated outside of India. While up till 2015, the only relevant criterion to determine the residence of a company in India was A, whether that company is actually incorporated in India, or B, whether its control and management was completely situated out of India. This criterion were revised in 2015 to say that apart from the incorporation, the second criterion is if the place of effective management of that company is in a year is in India. Now, place of effective management was defined further to mean where the key managerial and commercial decisions of the entity as a whole are made. Of course, this statement in itself was at the time thought to be very broad and not really defined. And so in 2017, the Indian Central Board of Direct Taxes issued detailed guidelines on what criterion are to be looked into to see whether a non-Indian company can be regarded as a tax resident of India. And basically, for Indian companies that are looking to either flip outside of India or relocate outside of India, the relevant, really relevant aspect here is to make sure that the key decisions of the company, the key managerial decisions of the company are not being made from outside of India. That is, the head and brains of the company are not sitting in India making these decisions. Becomes very relevant in contexts of companies which are founded by Indian individuals that are looking to externalize or set up abroad. Um, in case of certain tax treaties, in case of certain jurisdictions, you do have some protections under tax treaties that can be gone into, where you have tiebreaker clauses, where a company, can be regarded as a tax resident of India and that other country. The India-US tax treaty doesn't really provide that benefit, and in fact says that in such a case, the treaty, barring certain specific provisions, would cease to apply altogether. So a factor to be looked at all the more in depth for in the India-US perspective. Raj, this discussion on the cCorp structure was super interesting. You also mentioned that you wanted to discuss some other relevant structures that could be looked into for non-US investors investing into the US. Could you please explain those?
Yes, can you switch to the next slide? So here is another structure that we're seeing, and we're seeing this actually more and more often. It's where we sort of flip the structure, right? Instead of having the LLC or pass through below the C corporation, we have that above the corporation, and the business, and as we'll talk about later, the Indian business as well, would be beneath that C corporation. And all investors and all employees come in directly through that LLC. Now, that could also be a limited partnership in the United States. It could be a Delaware limited partnership if there are foreign or Indian legal or tax issues with investing in an LLC. LLCs are sort of unique vehicles. And so sometimes we see that for foreign legal or tax purposes, investing in an LLC directly can be problematic. And so it could be a limited partnership and essentially has the exact same tax treatment as a LLC with some sort of minor modifications. And this is sort of referred to as an LLC Top Coat because the LLC is on top. As you can see, it's far simpler, right? We don't have sort of a holding company C Corp that owns perhaps a majority of the LLC. By contrast, here the LLC holds all of the C corporation. It's a little less tax efficient in that all of the earnings of the C Corp are going to bear double tax when they pass through to the employees or the investors, but it's very simple. And so, like I said, it's becoming more and more common these days. And we do sometimes see clients decide that they want this simpler structure, especially in private equity, maybe less so with startups, but in private equity, we see the structure more and more. In fact, I'd say we probably see it in a majority of transactions as opposed to the Up-C structure.
Sure, thanks, Raj. Rajesh, just then jumping on to you. Could you comment on the structures that we've just discussed, the Up-C structure and the LLC Top Coat structure, a little bit in respect of, particularly from the point of view of exits and sales from these from these structures, and what would be the relevant considerations from an Indian perspective?
Thanks, Varsha. I think there are a couple of different points which are there, especially when we compare the C Corp Top Coat structure versus the LLC Top Coat structure. And the primary difference comes in, to my mind, in terms of how do we characterize the LLC for Indian tax purposes. Because with a C Corp, fairly clear, it's a corporation, no problem about it. It's effectively treated as a blocker for Indian tax purposes. When it comes to having the LLC Top Co or a LP Top Co, in both of those situations, the additional level of check that needs to be done is that how do we actually treat that for Indian purposes? A limited partnership ought to be treated or will be treated as a partnership for Indian tax purposes. The consequence of that is really today, and what we always need to worry about is, unlike in case of a company, where in order to treat a company as being resident of India, the place of effective management has to be in India. In case of a partnership, the test is slightly different. The test is effectively that even if a fraction of the management and control is in India, then it would effectively be regarded as a Indian tax resident. So in a limited partnership, that becomes an issue. So unless you are absolutely clear that the investors who are or the from India don't have any kind of management rights, then that's really the only scenario where you can think of a LP structure on top. LLC is a bit more interesting because fundamentally, when you look at some of the basic characteristics of what a corporation is, LLC meets those criteria in terms of having a separate existence, having its own charter documents and all of that. But having said that, again, is it absolutely clear? Has it been tried and tested in Indian courts? The answer is not really. A good example would be probably when we look at the UK, where while HMRC sort of regards the LLC as a company and any distributions being made by the LLC as being in the nature of dividends, but you also had case law, especially if I recollect right, on Anson, where the Supreme Court of UK did look at it, saying that we are going to sort of, while that was in a credit situation, try to give credit for the underlying taxes which were paid by the LLC, effectively not necessarily regarding it as an absolute blocker. So that's one aspect that we need to bear in mind, that while we look at having the LLC Top Coat, it is not absolutely clear. While to my mind, if we look at what is the characterization of the LLC, it ought to be regarded as a blocker, but it is not. It's not been tried and tested effectively in Indian courts. Coming in from an exit standpoint, again, the one difference which I would sort of say again goes back to the characterization, whether you're going to look at the entity as a company or a partnership, because your holding period sort of changes in terms of long-term capital gains. For any Indian investor, you're taxed on your global income. So irrespective of whether you're selling cCep, shares of a cCep or LLC interest or limited partnership interest, you're going to be taxed in India on that. Having said that, of course, what will change is your holding period, where for companies it's a 2-year, for in other cases it may extend to a 3-year situation. So that's one additional aspect that sort of comes into place in terms of how you sort of view the different structures. The one other possibility, and which sometimes tends to happen, again, I'm leaving aside the discussion on round tripping for a minute, or in terms of the source of funds, is where for Indian investors have a blocker corporation between the LLC and India, whereby they have, let's say, a Cayman Corp or some other entity, which will then invest in the LLC. Then what you are effectively trying to do is to achieve a tax deferral, so that until the money is actually distributed by, let's say, in this case, the Cayman Corporation, you will not be taxed in India. So that's one aspect that you'll have to consider. Of course, along with it comes in the issue that whether you can prove substance around the intermediate corporation, or you can show that the place of effective management is not in India around that. But that's one other aspect which comes into play in terms of from a exit standpoint, as far as Indian investors are concerned. Varsha, back to you.
Thank you, Rajesh. So we've discussed so far, common structures for non-US investors investing into the US. Let's talk a little more specifically about flips from India. Raj, could you help us a little bit on what are the common structures you see for companies in India trying to flip into a US-based holding structure?
Sure. So Varsha, can you go to the next slide? Which I'll talk about in a second. But I guess I want to ask Rajesh a question. As I mentioned, it's not surprising to me that that there's some confusion in India on how an LLC is taxed. We see that in many, many jurisdictions. And so my question would be, if we were going to go with that top coat structure, would you recommend that we use a limited partnership if we're taking in Indian investors? Would that add some clarity?
So Raj, I think between a LP structure and a LLC structure, I would actually go towards the LLC structure a bit more, because in a LP structure, it's an absolute rule that if even a fraction of the control and management is in India, the LP would be treated as an Indian tax resident. So, and the Indian taxation of a partnership is very different from how US taxation of partnership works, because in US, a partnership is regarded as a pass-through vehicle, whereas in India, a partnership is taxed in respect of its income, and distributions to the partners are not taxed. So the moment a LP is regarded as a Indian tax resident, the challenges actually increase. So while we can work with the LLC, I think sometimes the question that comes in is to say that whether it's in the charter documents of the LLC, to ensure that the characteristics of corporation are all reflected, because unlike in, let's say, a Cayman LLC or where I do have specific provisions which say that it is a body corporate, a Delaware LLC legislation today does not necessarily say that it is a body corporate as such, because, and from an Indian tax law perspective, the way a company is defined, it talks about a body corporate also qualifying as a company. So that's where really the ambiguity comes in as to whether a LLC should also be regarded as a company. But between a LP structure and a LLC structure, I would still sort of go towards a LLC structure much more than a LP structure.
Thank you. Okay, so turning to this slide, we're showing sort of the Up-C structure here, but we could do it with the top coat structure. You would simply swap out C corporation for LLC. And from a US perspective, this is a very simple transaction, actually. The Indian shareholders of the Indian company, they would receive C corporation stock, and we would transfer the Indian company to the LLC. So when the dust settles, the Indian shareholders of the Indian company, they would become stockholders of the LLC or members of the, stockholders of the C corporation or members of the LLC, and the Indian company becomes a subsidiary of the operating company below. And for US tax purposes, this is basically completely tax-free. Now, technically, this could be taxable for US tax purposes, but foreign investors are not taxable by and large such transactions. So that's why it's basically tax-free. So from a US perspective, this is like I said, a very simple transaction, and there aren't any US taxes to be paid. But I suspect that there's a great deal of thought that has to be given to it from a Indian perspective.
Thanks for that, Raj. So apart from the issues that we discussed in the previous round, which would apply for Indian investors seeking to invest into the US, Harshita, could you tell us what are the other legal considerations that need to be kept in mind in such a flip transaction?
Sure. So I think two interesting ones which come, which come alongside the regulatory and the tax considerations is the bit on, and the question that comes to everyone's mind is whether if the value consolidation is happening at the US holdco level because of the flip, can the US entity go ahead and issue ESOPs to the employees who are situated or based out of India and working for the entities? So the answer to that is yes. The US entity can go ahead and issue employee stock options to the employees who are working out of their India office, and vice versa. In case the Indian entity wants to issue ESOPs to the employees working at the US entity, that is also possible. So that was one piece on the employee stock option front. The other is around the IP. So again, if you're having your value and consolidating at the US level, and you have investors coming in at the US level, the question that the investors will generally want, or the consideration that the investors will really have in mind, is to bring your IP to the US level. If it is already residing in India. And to that, either you have an appropriate licensing arrangement built between the two entities, between the India entity and the US entity, wherein all the IP is transferred or licensed to the US entity, or if you're doing the flip early on in your stage, maybe register the IP in the US itself, so that you can essentially establish to your and market to your investors that the IP resides in the US, from where your main functions and activities or management of the company is going to be run by. So I think IP management and where your IP is going to be hosted is another important consideration you need to keep in mind, which will determine your the value.
Thanks, Harshita. Rajesh, going back to you then, what would you say would be the major Indian tax issues that need to be kept in mind and that keep coming up in these flip structures, particularly in light of recent changes that have taken place under Indian laws?
Sure. I think let's break it down into three or four different issues that sort of come about. The first one is the flip itself, because uh, as Raj pointed out, you do have exemptions in the US in respect of treating it as a tax neutral transaction. India, we don't really have those kind of exemptions, so it sometimes can become a challenge. We've seen situations where we've tried to swap out the shares of the India company against shares issued by the US parent company, so effectively swapping it in. One of the challenges obviously being the fact that it may not necessarily be a tax neutral transaction for Indian purposes. So that's one part of it which always comes in. The second aspect is that while Harshita did say that, listen, as a thumb rule, what you would ideally want to get to is not just from a structure standpoint to make it a US headquartered company, but also try to ensure that the IP does not necessarily vest in India. Again, whether it may vest in the US or whether we have another intermediate holdco between India and US is different, slightly different matter. I'm not going to touch into it. But again, there we are going to end up into transfer pricing concerns, especially in this day and age with the amount of changes which are happening both from a web standpoint and the aggressiveness with which India has been sort of trying to challenge on transfer pricing. So that does also become a bit of a concern, and especially when it comes to IP, the question of valuation is always a difficult question, which when it comes to it. So I think those are the 2 points which I would probably make in respect of just on the aspect around the flip, both in terms of the tax neutrality and also in terms of the IP transfer. Varsha, back to you.
Thanks, Rajesh. Raj, if I can just circle back to you quickly. We spoke about the specifics of the structures we just discussed, and we also discussed the typical flip structure that we just discussed. Just rounding off our discussion, could you spend a few minutes just summarizing what you would think are the key considerations that Indian investors need to keep in mind from a US perspective before they enter into transactions of this sort, or whether or before they set up a structure of this kind?
I guess beyond what I said in the initial slides about the U.S. taxation. I mean, the U.S. taxation of an Indian investor through a blocker, as Rajesh referred to it, we call it the same thing, is pretty sort of discreet and established, right? I mean, with a startup company, the great news is that the typical exit is going to be a sale of stock of that company, whether in an IPO or to a buyer, and there simply is no U.S. taxation. If there are dividends paid out of that corporation, whether through an LLC or not, then there would be withholding tax on those dividends, U.S. withholding tax on those dividends. Similarly, if dividends are paid from the Indian subsidiary up to the U.S. entity, I assume they'll be Indian withholding taxes paid, which obviously, we'd have to give thought to. We'd also have to give thought to transfer pricing from a U.S. perspective as well. So certainly there will be some sort of cross-border operations to think about. But I think the great news is that the structures which we've talked about, either the LLC Top Coat or the Up-C structure, they're intended to be very tax efficient for foreign investors. Those foreign investors could come in from India through a flip transaction, or they could be coming in through a venture capital fund. And we typically see VC funds sort of bifurcate their investment or split their investment so that their tax sensitive investors will come in through the blocker, and their other investors will come in directly through the LLC. Sophisticated VC funds like Sequoia, their funds are set up to do that. So that's the great thing. What we need to think about, though, is how is that Indian subsidiary going to be taxed from a U.S. perspective? And overall, we're going to have to make a decision whether we treat that Indian subsidiary as a pass-through or a corporation for U.S. tax purposes. It's kind of a fundamental decision you have to make, and it's difficult to change the decision once you make it. You're basically stuck with it for about 5 years at least. So it's something you want to give a great deal of thought to. And by and large, this election isn't going to affect the Indian investors. Rather, it's going to affect the U.S. investors, including the C corporation holding company. And if it's a pass-through for U.S. purposes, essentially what it's treated as, it's as if the Indian company is a division of the U.S. company. So to the extent that there are any earnings in the Indian company, you have to sort of translate those earnings into a U.S. tax financial statement or U.S. tax income statement, and record those earnings of that Indian subsidiary on the U.S. investors' tax returns, whether it's the corporation or individual investors. It would pass through our LLC if we had the Up-C structure, and they would pass through. The great thing is under that structure is that if there are any foreign taxes paid or Indian taxes paid by that subsidiary, they essentially will qualify for a foreign tax credit. It's a very simple system we have, and by and large, provided that the Indian tax rate is at or lower than our U.S. taxes, which are 21% federal for corporations and up to 37% for individuals, they get a dollar for dollar tax credit. It's very simple. The bad news is that all of the earnings pass through. So essentially, you have to pay all of the earnings of that Indian subsidiary, regardless of whether you've received any cash flow from it. So the downside is automatic inclusion. The benefit is automatic tax credit. As an alternative, we could elect for that corporation to be a corporation for U.S. purposes. Again, it's kind of a completely elective regime we have. And if it's a corporation, in all likelihood, it would be what we call a controlled foreign corporation. You have to meet an ownership test, but if you looked at the Up-C structure or the Top Coat structure, it would be a CFC. And then, but generally speaking, unless some of these broad exceptions apply, there isn't that automatic inclusion. We have to consider whether that CFC is producing what we call subpart F income or now GILTI income. And if so, that income is deemed to pass through. And what is subpart F income? Subpart F income is either passive income like interest and dividends, passive investments, or what we view as sort of abusive transactions, where we're simply using the Indian company as an intermediate to obtain a lower tax. If we have real operations in India, unlikely we're going to have subpart F income. GILTI is a brand new sort of tax regime that applies to CFCs. It means global intangible low taxed income. And it's actually, you see the word intangible and you'll think, well, if I'm exploiting IP in India, then I'm going to have GILTI. It's really well defined. It's really kind of almost any income under a complex test that's taxed at a lower rate than the U.S. tax rate of 21%. So if your tax rate is 21% or higher, you're not going to have GILTI. If it's taxed lower, you're going to have GILTI. and guilty is deemed to pass through to its US investors. Now, there's all kind of benefits to guilty for US corporations. They will get a foreign tax credit for the Indian taxes paid, even though it's a CFC and not a pass through. And they get a 50% exclusion for guilty under US tax law. And also we have this election that used to sort of never apply, but now people need to think about it all the time, which is that under Section 962 of our US Internal Revenue Code, an individual can elect to be treated as a corporation for CFC purposes. And the benefit is that that means that they can get these indirect tax credits. They can get the 50% exclusion for guilty. It's a really nice regime to apply that, hey, if I don't have these regimes apply, I don't have this phantom income problem from my Indian subsidiary. If I do have guilty or subpart F income, I'll get this indirect credit. And if it's guilty, I'll qualify for the 50% deduction. So again, if you're individuals in that Up-C structure, you'd be looking through the LLC and you'd be thinking about, should I make a 962 election for purposes of an Indian subsidiary? My guess is by and large, the answer is yes. If we decide for the Indian sub to be a corporation, it's hard for me to see a downside to that election. But again, there can be certain downsides in certain situations. So it's something you want to think, carefully about it. You can't really rescind the election once you make it. Finally, if it's not a CFC, let's say that you have to meet an ownership test to be a CFC. You have to own at least 10% of the stock of that Indian subsidiary indirectly. If it's not a CFC, we have to worry then about our PFIC rules. Is it a passive foreign investment company? And if it is a PFIC, again, you can have some really adverse US tax consequences. We can mitigate those consequences by making what we call a qualified electing fund election. Again, I'm sort of highlighting these issues, flagging issues that we need to think about. But if it's an Indian operating company, which we expect, the PFIC issues won't apply. And I guess the last thing we need to think about is that if we're paying dividends from the Indian company, there'll probably be Indian withholding taxes on those dividends. And can we qualify for reductions in dividend taxation under Indian law, under our US Indian tax treaty? For subsidiaries, the treaty nominally allows for 15% withholding, but obviously we'd have to defer to Rajesh and others to see whether we would actually qualify for those reductions.
Thank you, Raj. Rajesh, can I just throw it to you now for just some closing comments on the discussion that we've had since the beginning? We've had a very granular discussion. Could I just request you to quickly sum up what would be the overarching considerations that need to be kept in mind in these kind of structuring transactions?
Sure. Thanks, Varsha. And let me also pick up on some of the questions that I see. And I think a lot of the questions pertain to the flip and in terms of Indian investors owning shares in the US holdco. I think as Harshita pointed out right up front, one of the challenges that always comes about is when you have Indian investors and if they're holding shares in, let's say they had invested in the Indian company through their rupee funds. When you're trying to flip them over to the US company, you always have FEMA challenges because technically the only mode which is available if you're an individual Indian investor is under the LRS regime. And if you're a corporate, it's under the ODI regime. And both of them have their own set of restrictions. For example, in case of a LRS, you can only, if you're making a investment which is strategic in nature, you can only invest into a company which has a single layer and does not have layers underneath that. And that company itself needs to be an operating company. Whereas in case of a ODI transaction, we have the round tripping issue, which Harshita had alluded to right at the beginning. So which is where sometimes in flip structures or when we are looking at inversions, these are challenges that we always keep in mind, various ways in which we try to work it out, whether it is in terms of Indian investors having tracking stock in the Indian entity, which will track the overall enterprise value of the company, whether it's a situation where we sort of work out structures whereby the Indian investors get stock options or other kind of instruments for which they don't have to make a remittance from India, so that you are outside the scope of FEMA, because the moment you don't make a remittance outside India, then FEMA does not really apply. We've also looked at complex gift structures whereby shares are actually gifted to Indian investors. So all of those, and at the same time, we've also seen structures where we've gone in and obtained a RBI approval based on some very specific facts, especially when you're looking at, let's say, a company which has global operations. Sometimes, yes, it is possible to actually get approval from the Reserve Bank of India. So all of those considerations need to be borne in mind when you're looking at flip structures. Coming specifically to the point in terms of the Indian entity which is below the US holdco. Obviously, with the change in regulations in the recent budget, whereby we moved away from the concept of dividend distribution tax, which was an additional corporate tax on the company, to the classical dividend withholding tax. So you at least obtain treaty benefit in respect of any dividends which are being paid. If you go back to the period between probably 2012 to 2017 or so, a lot of the transactions were structured through sort of buyback arrangements to extract profits from the Indian entity, which was purely from the perspective that you would try to get a capital gains treatment rather than the dividend distribution tax. Some of those have been challenged and currently being litigated. But at least with the change, recent change in the budget, where they have introduced the concept of dividend withholding tax, or moving back to the concept of dividend withholding tax, it becomes a much smoother process in terms of distribution. The one other point I would make is that the other consideration which tends to come in, especially when you have the US holdco and then you have the India entity, is whether you keep the Indian entity as a corporate entity or whether you keep it as a limited liability partnership. Especially, and there are pros and cons on both sides, because with the company structure you can get a lower tax rate of 25%. But you will have the dividend distribution tax over and above dividend withholding tax when you distribute back to the parent, versus possibly a limited liability partnership where there is only a single level of tax. So both of them have their pros and cons. So and increasingly we are seeing a lot of structures where people do want to have a limited liability partnership structure, because the Indian entity is really a captive entity. Your shareholders agreement, your rights are all effectively in the US entity. So the Indian entity need not, and there is a lot less regulations around LLP. So that's one aspect which comes into mind. But I think across the board, I think that the theme that is there is that, yes, even while you're looking at any structure which has a US holdco, there are obviously multiple different nuances that we've gone through that we just need to bear in mind.
Thank you, Rajesh. With this, we will close our webinar session for the day. We had a very engaging discussion. Thank you, Rajesh, and Harshita for your inputs on this discussion. We've discussed from in the last 1 hour the typical structures that are in place that companies or individuals do set up when seeking to invest into the US from outside of the US, particularly in the context of Indian flips. Thank you again to the panelists for your inputs and really insightful words. And also thank you to all our attendees for attending this session today.